A fresh wave of US sanctions against Russia sends oil surging, pressuring India and China, two of the world's largest oil-consuming nations. While traders trim bets on Fed cuts after Friday's blowout jobs report, the pound extends last week's slump, dropping to the lowest level in a year. Plus, with UK assets under pressure, the Chancellor, Rachel Reeves, returns to from China today, facing growing calls to quell market jitters. Now, we'll be joined by Jim O'Neill, member of the UK House of Lords, former chair of Goldman Sachs Asset Management. At 9:30 a.m., we'll also talk about the markets with Janet Henry of HSBC. Now, let's take a look at the global macro movers. Now, we've switched things up. We always look at the European markets map, but actually there's so much going on around the world, and it's all linked, that we decided this would be the best way to look not only at sterling 121.37. We'll delve into that a little bit deeper when it comes to cross asset, but there's quite a lot of stuff going on with China, for example. So we had some trade surplus in China. It ramped up its support for yuan, and then a couple of other things that we need to watch out for, of course, is some of the concern as we head into inflation data. Traders, after that U.S. jobs report, that was really a blowout, underscoring resilience in the American economy, now need to see exactly what Trump policies mean for inflation. So cross assets, we're looking at the U.S. 10-year yield, but also sterling, as Rachel Reeves comebacks from China. So you can see sterling 121.38, the U.S. 10-year 479.23, so quite close to the 5% mark. S&P futures under pressure, down 0.7%, and then we start talking about oil with these extra sanctions. Brent 81.46. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, in a moment, we'll talk about the global bond sell-off, inflation, and, of course, weakening pound with Janet Henry, HSBC Global Chief Economist. But first, to really try and understand the impact of new aggressive sanctions on Russia, we're joined by Bloomberg's Will Kennedy. Oil has hit the highest level in more than 4 months after the U.S. announced fresh restrictions on Moscow's energy industry. So, Will and Janet, thank you both for joining us. Well, so I was a little bit confused because I almost thought that they did everything that they could already, and then suddenly there's quite a lot of anxiousness in the markets because of these extra sanctions that the Biden administration did a week before leaving office.
No, these are by far the boldest sanctions yet imposed on Russia by the United States. The United States and the Biden administration had actually been quite cautious in its approach because it wasn't wanting to drive oil prices higher. Clearly, this is a parting shot, and I think they feel it comes at a time when the market is generally quite well supplied, so there's room to do this. But the market has taken these sanctions seriously, and I think for 3 reasons. First, because they directly sanctioned 2 major Russian oil producers, Surgut Neftegas and Gazprom Neft. That's 1 million barrels a day. 2, they double the number of tankers that have been sanctioned. And third, they hit one of the biggest insurers of Russian ships. So you put those 3 things together, and the market is clearly worried that this could ultimately have a material impact on supply.
I mean, Donald Trump could presumably just roll them back as soon as he comes in.
He could. These are done by the executive, so they can be rolled back. But it's not clear that he would want to do that. It would be a very blatant way of doing a favour for Russia. It would not necessarily be popular with all parts of the Republican Party, especially in the Senate. And, of course, as he seeks to, as he said he wants to do, solve the conflict in Ukraine, this, of course, gives another piece of leverage in those negotiations, potentially.
Well, so that everybody fully understands, I mean, these are more aggressive, but also because they're more targeted. So you're basically targeting a tanker. It means that it's more difficult for refiners to change tanker from one to the other so that then it can get shipped off to China to be refined.
It makes trading Russian oil that much more complicated and difficult. And I think for India especially, which is A, a very important buyer of Russian crude, but B, always very keen to adhere to US sanctions and not violate them, they're going to have to work very hard to make sure their cargoes aren't coming from those oil producers, aren't on sanctioned tankers, and are not insured by the sanctioned insurer. And ultimately that means it's going to be more expensive, more time-consuming, and perhaps involve more ship-to-ship transfers, for example. So it does make that trade in Russian oil that much more difficult and expensive.
Well, thank you so much, Will Kennedy, who oversees all of our commodity coverage. Now, the sell-off in UK assets is continuing, with gilt yields higher across the board and the pound continuing to slide. Well, joining us now is Janet Henry, Global Chief Economist at HSBC. Janet, Happy New Year. It's so good to get started with Janet Henry on such a busy week to try and understand inflation and also what is happening in the UK. Is there a debt problem, or is it just in the eye of the storm?
I think what we've seen over the course of the last week, we know has been primarily a global issue. You know, what we have got everywhere is recent months, disinflation has slowed. We've got enormous policy uncertainty regarding, and this was in the Fed minutes, regarding trade policy, regarding immigration policy, regarding tariffs, etc. And there has been the particular UK angle in terms of concerns about the fiscal side, but that's not just a UK issue. But there seems to be a lot less confidence about UK inflation coming down than there is elsewhere.
But first of all, I mean, there's a huge concern about inflation coming down anywhere, and starting with the Fed after the blowout numbers from jobs, and then we'll have inflation figures this week. So are you worried, or are we accepting that actually it's just higher for longer in terms of interest rates?
I think generally speaking, even if interest rates come down a bit more, it's higher for longer, isn't it? But I think what's interesting is the recent momentum on inflation. This is an important week for inflation. And last week we had Eurozone inflation. It will probably be confirmed at 2.7. The US, it's probably going to rise to 2.9. The UK, it probably be confirmed at staying at 2.6. UK inflation is actually recent momentum no worse than it is in the US or the Eurozone. But markets look forward. And this is why there's all this discussion regarding the fiscal rules, but not just over the next 5 years. They want to be more confident. They want to believe the Bank of England's forecast that inflation is going to fall more sharply, so that there will be more scope for interest rate cuts, because UK rates are higher than they are in the US or the Eurozone. Yeah,
and Janet, I guess there's a concern, the buffers actually were a lot smaller that the Chancellor priced in or put together in her budget. Does it mean that there are question marks from investors on what the UK does next, including either tax hikes or cutting spending?
I think that there is some uncertainty, because clearly UK growth has been disappointing. The economy didn't grow in the third quarter. In October it contracted. We'll know this week whether in November it increased a little bit again. So you haven't got that growth lift. And as you rightly point out, the fiscal rules, very little fiscal headroom. So while there could be a tweak to 2029 or 2030, the market wants to see evidence of it now. My suspicion is if they need to do something sooner, it will be on the spending side rather than the taxation side.
So we sit in Europe, and I guess we're trying to understand these proposed changes in U.S. policy, which there's a lot of talk, but we don't know exactly where they end up. But also we're stuck between China and their promise of loosening monetary policy that we haven't quite fully seen yet.
No, we haven't, but I think that we will. It's clear that we will see more in the way of fiscal stimulus, and we will see more in terms of monetary easing, in terms of interest rate cuts and reserve requirement cuts. But the market keeps being impatient when growth is so sluggish, and while we are seeing some lift to consumer spending from these trade-in schemes, they want to see something more convincing. They want to be confident that employment prospects are going to rise. And while there is more in the pipeline in terms of pension spending and social security spending, you do need to get that confidence back in the economy, and certainly a stronger growth in China would lift, world trade to a larger degree, and Europe in particular. But remember, in China, this is a consumer story, not a manufacturing investment boom that in the past did list the likes of Germany.
How difficult is it to model actually some of the possible U.S. policy changes into growth forecasts for China, but also for Europe?
It's very, very hard, because we know that the data are going to be volatile. So, for instance, this morning we had that China trade data for December. Nice bounce in Chinese exports, particularly to the US, but also to ASEAN. It was even stronger. What we don't know at the moment is how much of that is the continued strength of the US and how much of that is ongoing front-loading. It's always called China's front-loading exports. US companies are front-loading imports in anticipation of these tariffs. So while we know what the general trajectory might be, because you're adding friction to world trade, you're not going to see it in the January or the February data.
But so what I'm struggling to actually get to the bottom of is at what point is this self-fulfilling prophecy? Is it really that, this U.S. exceptionalism means that the rest of the world will do badly, or can we somehow benefit if these tariffs are only threats and Donald Trump doesn't follow through?
Well, while you've got a lot of this uncertainty regarding trade policy and tariffs policy, it adds to uncertainty.
Right.
And the main area where you see uncertainty is on investment spending. So I think we can be confident that investment spending for now will be lower than it would have been in the absence of this uncertainty. But also, companies have been anticipating it. We've seen shifts in trade routes already over the course of the last few years. Those will be ongoing. Companies don't stand still. They may on the investment side, they may still be cautious, but they look for new routes, they look for new markets. It's just that cyclically exposed economies, reliant on exports, with which Europe is in, they're going to have to do more to support consumer spending and domestic investment as well.
What's your expectations for the U.S. economy? Is it all firing on all cylinders, or does higher inflation make it rethink some of, for example, Fed policy?
It's certainly still very strong. I mean, the payrolls release on Friday got the market headlines because jobs growth was way above expectations. It was not actually that much above the recent momentum. But this is, again, where there is an area of uncertainty. If employment growth in the US or population growth is 2%, because there are no controls on immigration, then actually you need to generate over 200,000 jobs per month. But if the brakes go on in terms of inward immigration, the break-even employment growth that keeps unemployment unchanged is only 100,000. So add that to your list of uncertainties.
All right, Janet, thanks so much. Janet Henry, their global chief economist at HSBC, stays with us, and we'll talk a lot more about the UK and also Europe next. Now, Apple sold 5% fewer iPhones and lost ground to Chinese rivals in the final quarter of last year. Now, the figures reflect the absence of Apple Intelligence in its largest market outside the US. You can see Apple not moving a whole lot, but pre-market down 1.1%. We'll have plenty more to come on economics, policy, and trade. This is Bloomberg. Welcome back, everyone. We're back with Janet Henry, global chief economist at HSBC, who's still with us. Janet, thank you so much for sticking around. We're having a great conversation on U.S. exceptionalism and where that leads to in 12 months. How difficult is Jay Powell's job now?
I think it's difficult, and this was what was very clear in the minutes from the last meeting, from the December meeting, when obviously they did cut rates, but it almost seemed reluctant, and they indicated that there would at least be a pause before we would get the next rate cut. But we've since had the minutes, and what was quite clear in those minutes, was that various members were concerned about the outlook for policy. And, you know, to some extent, it's a good way that they've moved away from a degree of forward guidance. How can you give confident forward guidance about what you're going to do on policy when you don't know what is going to happen to government policy in the coming months? So it will hinge on the data. And while markets are focusing very much on the inflationary implications, if we get controls on immigration, if we get tariffs, remember, high inflation can impact on growth. So they will then have to grapple between their two goals, which is potentially if growth is hit and if unemployment does rise, but inflation remains quite sticky, which one are they further away from? How much can they ease policy? And markets can be very volatile. Not so long ago, the markets thought we'd get 150 basis points of rate cuts. Now, lucky if we get 25, 50. We still do look for a little bit more than that, but it will depend on the data. But we are looking for, well, still sticky inflation, a gradual downward move rather than a strong reacceleration that forces them to tighten policy in the course of 2025.
And Janet, what happens with dollar? Because if you look at policies, it probably points to higher dollar rally, but they may not want that.
No, they may not want that. And I think this is why the incoming Treasury Secretary, Scott Bessent, his Treasury, I guess what he says this week in front of the Treasury will be important. I don't expect a change in tone in terms of what he says about dollar policy. Our currency strategists have been in the long dollar camp, the strong dollar camp for some time. They had looked for a period of consolidation, but since November, they've been looking for dollar to go through parity with the euro. Slightly below that. So it's still a strong dollar policy based on that view of stronger US growth and clearly the Fed cutting by less than the ECB.
And that, Janet, could be problematic for a lot of the emerging markets.
Yes, it can. You know, most emerging markets, the majority of them are in some form linked to dollar policy that will limit their magnitude for easing policy. And now they've got the potential headwinds of higher oil to some degree as well. And they will be, still a cautious outlook for emerging markets.
I mean, it feels like it's going to be complicated for a lot of the world.
Yes.
Is there anyone that will come out well out of 2025?
Well, I guess in some ways it might be some of the more idiosyncratic countries. Clearly, you know, Turkey was the darling of emerging markets over the course of last year. Actually, the disinflationary process has even taken a little bit longer in Turkey, but it has improved to quite a significant degree. We think the economic adjustment is still underway, and while markets have to wait a little bit longer for bigger rate cuts to come through, that still stands out as a potential area. And within Asia, we still like the growth stories, despite some recent disappointment in India and the likes of Indonesia. Some more specific countries, I think, will do somewhat better.
Where does Europe sit? So, you know, again, the ECB has to calibrate it, given there's elections in France in July for sure. There's also this February election in Germany, and it's very close to Ukraine with a question mark on what happens with gas exports.
Yes, I mean, clearly everyone is bearish on European growth. Forecasts have been falling for European growth, and the industrial sector has been extremely weak. The rest of the economy has not been quite as bad, and actually, to some extent, has been stabilising on the domestic side. We actually think that consumer spending could even tick up a little bit. But the market has repriced on the ECB as well. For a long time, we were considered to be in the hawkish camp for the ECB. We did not expect rates to fall below 2%. We've got a trough of 2.25. Suddenly, we look like the doves in the room. Political uncertainty. But I think what's different in Europe, Germany is particularly weak, but Germany is not the disinflationary force this time like it was pre-global financial crisis. Germany's got higher inflation than France, than Italy, and the rest of the Eurozone.
And on BOE, what are you expecting Governor Bailey to do? Again, there was a huge repricing.
There's been a huge repricing, and that's potentially, relative to our view, where there is the biggest mispricing. We think that the Bank of England's got some low inflation forecasts. Ours isn't quite as low, but they need to improve their communication and their confidence with which they expect inflation to fall to the numbers they're projecting.
Janet, thank you so much, as always, for joining us. That was Janet Henry, Global Chief Economist at HSBC. Now, coming up, the wildfire threat in Southern California is far from over, with forecasts of dry, hot winds in the coming days. We'll, of course, have all of the details next, and this is Bloomberg. Well, residents and firefighters in Southern California are bracing for more strong winds early this week. The powerful gusts are expected to challenge crews struggling to contain two destructive blazes, which have left at least 24 people dead. Now, for more on this, let's turn to Bloomberg's Iman Farhat. Iman, so what's the latest when it comes to the evacuations?
So there are about 100,000 people who are still under mandatory evacuation measures. Now, this is days after the blazes started coming out, so it's quite extreme. And at the same time, as you said, there are going to be more winds this week, and about 8 million people, or up to 8 million people, are being warned that there could be wildfires in their areas. So it could change quite quickly, and millions could be affected this week.
What's the biggest worry right now?
I think you're right. On these high winds, that does mean that could mean very quickly that winds would pick up, that the blazes would spread much further. But at the same time, it also means that crews can't operate. And if these winds pick up, that really could make the efforts, stop, but also maybe make us go backwards if we lose all of that progress that we made in the last week and this weekend.
What else are we watching for? I know there are firefighters coming from all over the world trying to help. I don't know if the access to the water is the most difficult part.
Yeah, I mean, the water pressure, that's one thing that we've heard from the authorities. LA is not set up to deal with fires this big. There aren't enough firefighters probably in the whole state to deal with these fires. There are people from Mexico, Canada, other nations helping out. But it just seems that, if these winds pick up, a lot of that progress could be lost, and then these other crews could really become essential, as well as the water supply. Yeah,
is it too soon to talk about reconstruction costs? We haven't really heard about that.
Yeah, I mean, the cost of the economy, the cost and all that, the estimates keep ballooning. I saw one this morning where it was going up to like 250 billion. A few days ago we were talking about 50 billion. So it's obviously we're not sure right yet. I've been hearing from firefighters that, when you look at the devastation, it does seem really worrying, and we can't really assess it, but know that it's going to be one of the worst in US history.
Thank you for joining us. Eamon Farrett there, of course, will stay on top of these fires and bring you the very latest from LA. Now to some other stories making news, and U.S. authorities have agreed to extend the deadline for Nippon Steel to end its bid to take over U.S. Steel. The Japanese company will now have until the 18th of June, following President Biden's order to halt the $14 billion takeover bid earlier this month. Now, both companies have appealed to a federal court, arguing that the Biden administration blocked the deal for purely political reasons. And the U.S. Supreme Court has signaled it's likely to uphold a law that could ban TikTok if its Chinese parent company does not sell by January 19th. Now, a majority of justices suggested they see U.S. national security concerns as overriding the free speech interests of companies and content creators. ByteDance argues that TikTok is an American company incorporated and headquartered in California. This is a picture for U.S. futures. We're seeing NASDAQ futures, for example, extending their losses down 1.5%. Again, a lot of the focus will be on inflation figures a little bit later on this week, after we had this blockbuster Friday payroll data that complicates things for inflation and the Fed. Coming up, we talk about the UK as the Chancellor returns from China. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. A fresh wave of U.S. sanctions against Russia sends oil surging, pressuring India and China, two of the world's largest oil-consuming nations. Traders trim bets on Fed cuts after Friday's blowout jobs report, while the pound extends last week's slump, dropping to its lowest level in a year. Plus, with UK assets under pressure, the Chancellor, Rachel Reeves, returns from China today, facing growing calls to quell market jitters. Now, the outgoing Canadian Prime Minister, Justin Trudeau, says his country is not looking for a trade fight with the new Trump administration, but will retaliate if the U.S. puts tariffs on Canadian goods. Now, for more on this, let's bring in our EMEA News Director, Rosalind Matheson. Ros, so when you look at, good morning, first of all, a lot happening over the weekend, and actually it seems that you have to respond if you're a leader, and that's certainly what Canada's Prime Minister did.
Well, that's right. So he's laying the table saying, of course, if you come for us, we'll come for you, even though Justin Trudeau will only be Prime Minister for a little part into Donald Trump's time as president. But saying again, if you're going to put widespread tariffs on Canada, we will retaliate. And we're looking at how. 2018, when we saw this also, was quite different, though. It was like the US putting targeted sanctions on steel, aluminium, Canada coming back against things like household appliances and bourbon whiskey and boats. We're talking about a very different scenario with blanket tariffs the US that might be putting on Canada. How do you respond to that? And of course, reminding the US and Donald Trump that Canada is the biggest buyer of US made goods. So this is not something that wouldn't boomerang back potentially onto the US economy. And a lot of conversation we can see about how Canada might respond. Could they go as far as to curb energy exports to the US? Electricity exports, over the border area into the US. That doesn't seem to be on the table, but we are looking at a very complex moment, particularly again with the Canadian Prime Minister going out the door shortly afterward.
Yeah, it's also, there were some strange, thoughts from Donald Trump saying it'd be beautiful if Canada was part of the U.S. I wasn't really sure what to make of that. Now, the Mexican president, she also responded, speaking to a crowd after comments he made last week.
Well, that's right. And she was saying that, again, that Mexico won't be subordinated by the US, but also said the relationship can be good and will remain strong. How you guarantee both those things, is quite tricky. And looking back again to previous times, yes, we did get a renegotiation of the North American trade agreement. Her predecessor was part of that, but that was then, this is now. Very different, talking about targeted parts of each other's economy and blanket sanctions and tariffs, rather. And what does that mean for the relationship? So how, again, Mexico manages that? Do you work together with Canada? And in what way do you join forces with Canada against the US on this? Do you bring in other players? Do you essentially double down and really, develop your economic relationship with China as a buffer. There are all sorts of potential, unintended consequences from this, but it's very hard to tell until Donald Trump gets in the door and says clearly what exactly is he going to do.
Yeah, inauguration exactly a week from now, so it's next Monday, January 20th. Now, we also heard from Jamie Dimon talking about tariffs and Donald Trump. This is what he had to say.
To me, tariffs are a tool properly used that can help get some of those issues resolved. Unfair competition, national security issues. If like any tool, if it's misused, it can do damage too.
Not sure what to make of those comments, actually.
It was interesting to hear the remark properly used. I mean, he's saying in that interview, you can understand why Donald Trump was re-elected. He talked about the fact he feels previous governments have neglected national security, the resilience of supply chains, supporting the economy, supporting business. And tariffs are a part of that economic toolbox, as he said, if used when you're actually alleging, misbehaviour by another country. Used as a political tool, which is what Donald Trump seems to want to do, quite different. The properly used really stood out to me. And he's saying, they can also cause problems. So in a way, a bit of a warning maybe to Donald Trump, just if you're deploying these as a tool, make sure you're thinking about what might be the effect of it.
Ross, thank you so much. As always, Ross Matheson, there, our head of our EMEA news desk. Now, on to the UK and the Chancellor returning from her weekend trip to China as the sell-off in UK assets continues. The pound is at its lowest against the dollar since November 2023. Traders betting on it falling even further. Now, despite UK government borrowing costs soaring last week, Rachel Reeves is sticking to her guns.
The fiscal rules that I set out in my budget in October are non-negotiable, and growth is the number one mission of this government, to make our country better off.
Now we're joined by Jim O'Neill, member of the House of Lords, former chairman of Goldman Sachs Asset Management as well. Jim, thank you for joining us. You look like a podcaster. When you look at the market moves that we saw last week, how much further do you think yields will rise and the pound will fall?
So first of all, Fran, I encourage Bloomberg, given how objective you guys are, is to get out a chart for your customers of the trade-weighted value of the pound. I am quite shocked as to how widely a lot of British mainstream media is talking about some supposed big drop in the pound. What they seem to be confusing is something really basic, which is we have a very strong dollar. And the dollar is rising against many, many currencies. I think there might have been about 2 hours last Wednesday where the pound fell a bit faster than any other currency. But we do not have a weak pound. In fact, if you look at the trade-weighted value of the pound, I think it's actually risen over the past 15 months and has been pretty stable since the Labour government came into power. What we have got is a very significant rise in bond yields going on, and it is a bit more in the UK than in other countries. And so that is obviously an issue for the interplay with UK fiscal policy. But the kind of drama that the British media is turning this out to be is kind of a bit mind-boggling to me, because it's not really anything to do with the UK. And having just looked at some data preparing for this, it might get worse, because I hadn't realised I caught up with the US payrolls, but I've even if not anything greater concern, that the long-term University of Michigan inflation expectations release came later, I think, Friday, for 5 years, rose to 3.3%, which is a huge jump by the standards of that index. So I think we've basically got markets starting to worry about inflation again. And I noticed similarly that there's a big rise in crude oil going on in the past week as well. So it's not obvious to me that anybody in the UK can do anything about any of that, frankly. So I'm not quite sure why there is this almost hysterical mood out there.
I mean, gilts moved, and gilt moved quite a lot. So there was a pretty painful sell-off. Now, it was maybe started in the US, but it feels like, and you're saying maybe this is the wrong way of looking at it, but it feels like the epicenter is the UK, or certainly the UK is taking the brunt of this turmoil.
Well, as I said, I mean, it's pretty easy to measure these things. UK 10-year yields have risen a bit more than other places in the past few months, but it's not as though it's a UK centric thing. There has been almost exactly the same rise in US bond yields over the period since the Chancellor's budget, and yields are going up everywhere. But let me bring in two other things that are very specific to the UK. First of all, I do think, despite what I've said, the markets are not trusting at the moment the new government's commitment to their own fiscal rules, partly because it's still new, and also because they did a couple of odd things in their budgets. And so it's sort of partially understandable. And I myself, as somebody that is a big fan of their new fiscal rules, I think they need to deliver more about it when they come up with their spending review, and in particular the rollout of the 10-year borrowing and investment policy in the spring. I think that is for me, that is the real test of this. The thing going on in parallel is obviously because of the tax hikes they did, and every business person you speak to talks about it. Business confidence is being given a big whack. So there is a focus on UK growth, which I think is valid. But this idea about some kind of crisis in UK markets, I think to me, it's a symptom of the never-ending 24/7 chattering classes of people that have just got to talk about something because the 24 hours where they have to show something.
Jim, if you were Chancellor, would you ignore it, or does she need to do something to get ahead of these market moves?
Well, I'll turn it back on you, Fran. What exactly is it she can do? Let me give you a particularly daft thing that goes in my head. Can you imagine if, for some reason, the Chancellor says, OK, yeah, I'm going to have a little mini January budget, even though it's only 2 weeks into the new year, and I'm going to tighten fiscal policy again. And then 2 weeks later, after we get some surprisingly good US inflation news, bond yields drop by 40 basis points. And then we have lots of people writing stories about how the Chancellor's got a whole load of fiscal room to do some stimulus. And so, you could be in this never-ending silly merry-go-round because of a move in global bond yields. More sensibly, there isn't any pressure on her to do anything about the markets or her own rules till at least March, when the OBR will come out with their updated forecast. So I don't quite. I can see the kind of fun and games of must be a lot of fun for the Tories in the House of Commons and to some degree the Lords, given the bashing that they've had. But I don't really get why this is such a big topic. It's kind of a bit strange to me, to be honest.
Well, because at the moment, I mean, she had buffers that were so razor thin. If market continues falling, then she'll have to find extra money. And I don't know whether it's U.S. markets, Jim, that are latching onto this, but there's uneasiness in the market. And, I guess the worry is that if she doesn't address it, it gets worse, and then it becomes a crisis confidence.
So here's the second thing I was waiting to find the right point to add. And I don't want to get either academic or too sort of technical, but this is a government that seems to be being, quite rightly in my opinion, pretty seriously committed to trying to boost investment in real assets and infrastructure and what people would call illiquid investments. And if you are trying to do that, and that's partly what the spring policy initiatives are going to be about, it is quite likely, therefore, that there's going to be less domestic buyers of UK gilts if you want them to buy something else. So unless we raise our domestic savings rate, then there will be some kind of compensatory move higher in gilt yields to attract other buyers. And if I were Rachel Reeves or if I were a policymaker, I wouldn't overly worry about that because that's kind of what I'm trying to do.
Right.
The real crux is, are they going to come up with initiatives that are really going to stimulate economic growth? And I think a lot of that depends on the things they're going to be announcing soon about regulatory steps, whether they can really get the housing market going in the way they've talked so ambitiously about. And crucially, and this relates to gilt yields, can they announce investment projects that have a massive positive economic multiplier that results in the OBR boosting their trend growth forecast.
Right.
And if they can do that, then I think you'd see a very different mood, particularly coming out of the UK equity market, which is clearly and understandably quite bothered about the evidence of a slowdown in growth.
But, Jim, those projects would also have to yield results quite quickly if they're going to be folded into the OBR. Is that possible? What would you target?
I don't agree with that. I think what is particularly admirable, it's really politically challenging. I think if the government can focus on things that are going to truly change the trend growth performance of the UK and boost productivity, whether that be something I'm very interested in, for example, Northern Powerhouse Rail, or something that is highly topical, instead of boosting more day-to-day health spending, boosting preventative infectious disease and related health investments, I am pretty sure that would cause the OBR to boost their long-term growth forecast from what is currently around 1.6 to something closer to 2. And given the importance, and justifiably so, of the OBR's independence and their skills, I think that would influence quite a lot of sell-side analysts in this country, or people looking at it. And in turn, that could therefore raise the equity risk premium and change the whole tone of that part of UK financial markets. So part of the problem of British governments the past few years is this obsession with trying to find some policy initiative to influence growth in the next week. And the problem we've got is really weak productivity and very weak investment spending. The only thing that I think they really could do to change the mindset of growth in the short term is to be quite successful about getting the housing market going in the way they're talking, as well, of course, as changing the mood, which has turned so sour since the budget amongst the business community.
Jim, if you were needing to find some money in March and you were the Chancellor, where would you find it?
I think we know where it's coming from. I interpret the Chancellor's comments from Beijing or Shanghai as that she will toughen up further on spending. I think it would be very, very, very difficult for her to change her fiscal rules, and I don't think she should. And I think she's pretty much ruled out any further big rises in tax increases. So I think it would be further tightening up or fresh tightening of current spending rules. Let me throw in another thing on the back of that. I don't think it's a bad thing that the markets or the coverage of the supposed market woes is going on, because that in itself, I think, will force the government to be truly disciplined and truly focused on their own fiscal rules that they've introduced.
Jim, when you look at inauguration next Monday, Donald Trump gets into the White House. We had this blowout U.S. jobs number on Friday, coupled with policies that could be inflationary. What's your biggest worry for, allies of the U.S. in 2025?
Well, that goes back to my core thesis of how this UK market development should be looked at. There are a lot of things to be concerned about as it relates to the US. As you said yourself, very strong jobs number we had Friday. And as I touched on myself, because it's something I've followed for most of my full-time professional life, and I still do, I think the big rise in 5-year inflation expectations is something that will trouble quite a lot of people at the Fed. And, it's not impossible that we are in the early stages of the Fed not just shifting from instead of doing 4 cuts, only 2, that within another month of indicators like this, the Fed will be telling us they're not going to be cutting at all, and they'll be thinking about the opposite. And what is so difficult for everybody to figure out, given the character we've got coming into running the US in the next week, Mr. Trump, it's hard to know how much he would stick to even things it appears he's really committed to, because amongst the other things that appear to be pretty clear about Trump, he doesn't like markets saying they're not happy with what he's trying to do. And it's very interesting if you look at the US stock market. It's had a pretty challenging time the past 3 or 4 weeks, including some of the things of a lot of his now new close allies have dear to their heart. And if you look at the famous MAGA 7 and some of the really, really buoyant stocks of the past couple of years, they've started off this new year not being too happy with life. And if the US bond yield developments knock on badly for those again, that in itself might not be an unhealthy thing. And I think personally it might empower the likes of Scott Bessent coming in as Treasury Secretary, because despite, and I noticed with interest your reference to the Jamie Dimon comment, despite how quite a lot of people suddenly finding it fashionable to say that tariffs can be useful, I'm sufficiently old school that I just don't buy that. I think the combination of significant tariffs and a fiscal expansion from the new president, on top of the very strong cyclical state of the US labour market, is not a great recipe for financial markets.
Jim, thank you so much, as always, for joining us. Jim O'Neill, the former chairman of Goldman Sachs Asset Management, talking, of course, about the UK and possible Trump policies. We'll have plenty more in the markets ahead. This is Bloomberg. European natural gas prices jumped in early morning trading. This as analysts warn that Europe is at risk of failing to meet its storage targets for next winter. Well, with us now is Bloomberg's Rachel Morrison, who oversees all of our gas coverage. So what are the potential consequences, Rachel, if Europe fails to meet its targets for next winter?
Well, we're really looking at potentially much higher prices. So if Europe ends the winter with very low storage of gas, then it'll be potentially open to this big global competition to try to get supplies of gas. So we'll be looking at competing with Asia and everywhere else, also looking for extra gas in the summer. And it could really lead to much higher prices. And I guess potentially in the end, if we don't make those targets by the end of the summer, that would be, put more pressure on next winter, but really it will be a much, it will support prices going into the summer.
Who does the negotiation? Is it country by country or is it as a bloc?
Well, there is a bit of both. So since the crisis, Europe changed to do some gas purchasing as a bloc, but it's really down to the country that owns the storage to make sure it's full.
Rachel, thank you so much. Rachel Morrison there with the very latest on gas prices. This is Bloomberg. Euro dollar actually extending the drop, falling some 0.6% to hit the day's lows of 1.0178. U.S. futures, if you look at the impact that blowout number from the U.S. has had, quite a lot of pressure now on what happens with the inflation figure in the U.S. a little bit later on and what that means for Fed policy. So that's dragging a lot of the stocks to the downside. NASDAQ down 1.4%, S&P futures down 1%. So we not only have quite a lot of data from the U.S. this week, we also have Scott Bessent talking, of course, and testifying. So it'll be interesting to see a little bit more what he thinks about dollar policy. Up next, Bloomberg Brief. Danny Berger and Manus Krani in New York, and this is Bloomberg.